New data from overseas shows imports into the U.S. are down since the tariff war started, while exports to other countries are quickly climbing.
This means major powers such as China and India are finding other markets for their products. Madeline Rivera has more from Washington.
The U.S. is facing rising consumer prices and supply chain problems. Americans are seeing increasing costs for food, energy, and housing.
The story begins with a sobering reality. Across the United States, families are struggling to keep up with rising costs. Groceries, energy bills, and housing are all becoming more expensive. At the same time, supply chains are breaking down, leaving shelves thinner and consumers frustrated. New trade data reveals that imports into the U.S. have declined since the tariff war began, while exports from other major powers are surging as they shift to alternative markets. China and India, once heavily reliant on American buyers, are now building new networks that bypass the U.S. entirely. In Washington, the year 2025 started with bold speeches about a self-reliant America, an America that would no longer depend on foreign supply chains for its essential industries. But those promises have already collided with economic reality. Facing pressure from automakers, manufacturers, and consumers, the administration issued a sweeping executive order rolling back tariffs on critical imports such as nickel, graphite, and pharmaceutical compounds. This reversal signals an admission. American industry cannot yet stand on its own. The decision is a lifeline for car makers in particular. Without access to affordable imported materials, many risk collapse. But the broader implications extend beyond automobiles. They touch on the very structure of global trade and raise pressing questions. Which industries stand to gain the most from this policy shift? Which partners will Washington reward with tariff exemptions? And most importantly, how will these changes ripple through the economy, shaping prices, jobs, and consumer choices in the months ahead? America's struggle begins with an undeniable fact. The country consumes far more raw materials than it produces. Modern industries, from clean energy to advanced electronics, require massive volumes of metals and minerals. But U.S. mines and refineries cannot keep pace. Graphite, a crucial component for electric vehicle batteries, offers the clearest example. In 2024, the United States consumed 52,000 tons of natural graphite. Not a single ounce was produced domestically. Every pound was imported. And because China controls over 90% of global graphite processing, even graphite mined in other countries often passes through Chinese plants before reaching U.S. manufacturers. Nickel follows a similar story. A small mine in Michigan contributes modestly to supply, and recycling programs provide some relief. But the overwhelming majority comes from allies like Canada and Australia, with most processing performed offshore. Aluminum, gold, and other metals repeat this pattern. Imports from Brazil, Jamaica, and elsewhere that fill the gaps left by insufficient U.S. capacity. For automakers, this dependency creates volatile costs and constant uncertainty. Tariffs were supposed to shield American industries, but instead they magnified vulnerabilities. In 2025, auto tariffs reached 25%, while steel and aluminum duties surged to 50%. Analysts estimate these increases added $18 billion in expenses for U.S. automakers this year alone. That translates into roughly $5,000 extra dollars on every American-made car and more than $8,500 on imported models. The consequences are crushing. Already operating on slim margins, many car companies have chosen to absorb part of the losses rather than pass the full burden to customers. They have trimmed model options, scaled back profits, and hidden fees in contracts. But this strategy cannot continue indefinitely. Luxury vehicles and electric cars, both heavily dependent on foreign components, will be the first to see significant price hikes. Consumers are already squeezed. Interest rates remain elevated, making financing a car more expensive. When rising tariffs are added to the equation, new vehicles risk slipping out of reach for average buyers. For many households, the American dream of driving an affordable new car is fading. The administration's policy reversal has temporarily eased the pressure, but the exemptions are not open invitations. They are bargaining chips. Washington has made it clear that tariff breaks will only go to nations willing to strike reciprocal deals. This approach has triggered a global race. Governments around the world are scrambling to secure favorable terms for their industries. The European Union and Japan acted quickly, negotiating agreements that cut auto tariffs to around 15%. South Korea followed suit, pledging new investments in the United States in exchange for lighter duties. India, previously penalized with a 50% tariff because of its ties to Russian oil, is now pushing for reductions that could lower its burden to the 10 to 15% range. Taiwan, facing a 20% duty, has also reported progress in talks. This patchwork of deals creates an uneven playing field. Automakers whose home governments strike favorable bargains gain a powerful edge. Those left out face steep penalties that could cripple their competitiveness. The result is an industry forced to gamble on uncertain diplomatic outcomes. Car production requires years of planning, yet tariffs can shift overnight. Efficiency and engineering are no longer the decisive factors. Political alignment is. For consumers, these maneuverings translate directly into the price tag on the showroom floor. Every adjustment in tariff policy eventually filters down into higher costs, fewer vehicle options, or longer delivery times. Shoppers may find that the brand they prefer is suddenly hundreds or thousands of dollars more expensive simply because of trade negotiations conducted halfway around the world. Automakers are scrambling for solutions. Some are expanding plants on U.S. soil to reduce reliance on imports. Others are experimenting with recycling programs, hoping to reclaim valuable metals from used batteries and scrapped vehicles. Many are seeking new suppliers to diversify sourcing. Yet these efforts require years, if not decades, to fully bear fruit. Supply chains built over generations cannot be rebuilt overnight. Meanwhile, the political stakes are rising. Investigations under Section 232 are already underway into goods ranging from polysilicon to wind turbines. Each new probe creates uncertainty, discouraging investment, and complicating business planning. The so-called tariff relief is not a reset button. It is a temporary reprieve, and the cloud of uncertainty hanging over the industry is likely to grow heavier. The broader reality is uncomfortable. American manufacturing, despite political slogans, depends on a steady flow of imported resources. Exemptions may offer breathing room, but until domestic refining and production scale up meaningfully, the foundation remains fragile. Showrooms will continue to reflect these vulnerabilities. Cars tied to privileged trade partners may stabilize, while those linked to penalized sources will face volatility and higher prices. Looking ahead, three factors will determine the road forward: where critical parts are sourced, which trade deals are secured, and how quickly domestic infrastructure can grow. If these elements align, prices could cool, availability might improve, and consumers could regain confidence. If they do not, trims will disappear. Waiting lists will return, and creeping costs will push more buyers out of the market. The brands that combine strong engineering with strong negotiating power will emerge as winners in this new landscape. And yet, the uncertainty in America's auto sector mirrors larger tremors in the global economy. Consider Russia. For over 2 decades, Vladimir Putin cultivated an image of strength, portraying his country as immune to outside weakness. Oil and gas revenues poured billions into state coffers, and oligarchs flaunted their wealth abroad. But beneath the propaganda, the economic foundation was fragile. Today, the cracks are impossible to hide. Ordinary Russians face emptying shelves, rising prices, and a devalued ruble. Families ration food and stretch meager wages. Jobs vanish, paychecks shrink in real value, and stability, the social glue of Putin's rule, drifts away. The war effort consumes vast resources, draining billions of rubles while robbing communities of their young men. Millions have fled to avoid conscription or escape a suffocating economy. By 2030, official forecasts admit nearly 11 million workers will be missing from the labor force. Factories are already struggling to keep lines running. The once mighty energy sector, along the backbone of Russia's power, is faltering. Drone attacks on refineries have knocked out over 13% of capacity. International buyers are reducing their reliance on Russian fuel. The Kremlin's identity as an energy superpower is slipping, undermining its leverage abroad. But perhaps the most striking blow is the quiet retreat of China. For years, Beijing promised unwavering support, serving as a financial shield against Western sanctions. Now even regional Chinese banks are cutting ties, wary of punishment from the West. Deals collapse midstream. Russian companies find themselves locked out of financial networks they once relied upon. What remains of the partnership is reduced to convoluted back-channel transfers and inefficient workarounds. Inside the Kremlin, the math no longer adds up. Defense spending surges, oil revenues shrink, and currency reserves vanish. Every ruble spent on weapons means less for hospitals, schools, and infrastructure. High interest rates choke off investment and consumer spending. Economists describe Russia's trajectory as a narrowing corridor. Raise taxes and businesses collapse. Print money and inflation soars. Cut spending and society feels the pain of neglect. For Moscow, the options are running out. And for Washington, watching from afar, the lesson is clear. No country is immune to the consequences of over-reliance, whether on foreign buyers or foreign suppliers. So where does this leave the United States? Will tariff shifts by automakers the time they need to rebuild supply chains? Or are they merely delaying the inevitable reckoning with structural weaknesses in domestic production? Will consumers accept higher prices, or will demand collapse under the combined weight of tariffs, interest rates, and economic slowdown? These are the questions that will define not only the future of American trade policy, but also the everyday lives of millions of families. The clash between political promises and economic reality is only beginning. Are we witnessing the start of an unprecedented economic crisis? How long can American industries survive as tariffs and trade wars reshape the marketplace? And how will households endure as prices rise and jobs remain uncertain? If you want to know what happens next, subscribe now and like this video to stay updated. Don't miss the latest insights into how trade, tariffs, and economic power games are shaping our world. The story is far from over, and your perspective matters. Share your thoughts in the comments below. We want to hear from you. Thank you for watching, and we'll see you in the next video.